how it has panned out throughout today's session, as well as where the gains and losses seen, and what should be your investment strategy going forward from here, the pockets and the stocks that you need to focus on to protect the returns and to maximize the returns on your portfolio. Joining in is a very special guest with me, Mr. Krati Batini joins in from WealthMills Securities. Thank you very much, Mr. Batini, for taking the time out. Well, it's been a bad start to this week. Another 650 points gone on the Sensex today. The Nifty has also breached the 17,000 mark at closing level as well. How are you looking at this time and again correction that we are seeing constantly in the market, the steady decline that's been happening, and the constant chatter across the global markets on Fed hike, on inflation, on crude prices, on rising COVID, everything perhaps standing as headwind for the markets in India.
Actually, markets are at a very inflection point. We need to consider and look at the Nifty 200-day moving average. Market today violated, but market last week, market couple of times, it violated that level and it could able to rebound from that 17,000 level. So we need to wait for global cues, how they are going to pan out. Right now, we need to see two factors, Sakshi. One is the domestic as well as the overseas, how the cues are coming.
Right.
The overseas cues, what's happening, the initial commentary that's coming from Fed, the interest rate hikes, and also the inflation is the major cause of worry across the globe. But investors need to understand inflation is better than deflation. So thank God we are in an inflationary situation than a deflationary situation, how we witnessed during the COVID times.
Yes.
So going ahead, how the central banks are going to take the decision rate hikes, it's a synchronized rate hikes that going to happen across the globe, or how the central banks position themselves to allow the growth to take place, taming the inflation. This is the major crux for the markets going ahead. Domestically, coming to Indian markets, we are at an inflection point. That's what I told. And if there is any slight cool down in the crude oil prices, that will help India a lot. And also, as we are heading towards the next MPC meet, so how Indian Monetary Policy Committee meeting, RBI, is going to take the decision in terms of the interest rate hikes are concerned, that's going to play a vital role in the markets. Coming to the result season right now, result season is good. All the companies, there are no negative surprises in line with the expectations. So there is nothing to worry for the investors. These are the part and parcel of the global cues that are keeping pressure on Indian markets. And also FIs are the continuous sellers in past, we can say 90 trading days. That's what creating more extra pressure on Indian markets. But thank God, but in earlier bull rallies or bear rallies, what we witnessed, whenever there was a selling of FIs, market used to collapse. But this time market, because of the domestic liquidity that's coming into the markets doing good in terms of the market stock levels are concerned.
Okay, understood that. So global factors along with domestic factors you suggested to us, and how Indian markets are right now at an inflection point. But what is the best way for investors to navigate through this constant volatility that we are seeing on the markets? How to protect one's returns on the investments that one is making on the stock markets in India?
Going ahead, Sakshi, we need to habituate this kind of volatility. Because of the global cues and the geopolitical worries that are keep on coming back. And also, if we see the Chinese market, major the COVID outbreak in some parts of China is also one of the key worries. So market is all these factors. That's why we can see this kind of heightened volatility in the markets. But for the investors, they can come across this kind of volatility. The best thing for the investors to come across this kind of volatility is the staggered approach they need to position themselves. If they have to buy 100 shares, they can start buying with 10 shares. And whenever buying on dips in Indian market always pays for the investors. So buy on every dip. And if they find the excess exuberance on a single day during these market conditions, so on that exuberant day, they can book some profit from the table, and keeping the equivalent cash level in their portfolio gives a better strategy for the investors during these kind of volatile moments of the market.
Okay, understood that as well. So a staggered approach in the market is the best way to beat the volatility and in fact take benefit from it. And all the kind of dips that you're seeing in the markets could actually be used to add on some good fundamental names to your portfolio at this point in time as well. But speaking about some specific sectors today which got hammered the most, talk about the realty space. Sharp decline of 3.8% especially we saw there. Could you help us understand what were the key reasons behind the sharp fall in the realty stocks and how should one trade them now?
Actually, as the realty stocks are interest rate sensitive, if the interest rate liquidity tightening that's going to happen in the economy, the first and foremost sector that's going to impact it is the reality stocks. But what we can see is one kind of positivity also there in reality stock, because there is heightened activity in terms of the commercial reality is concerned. IT companies are recruiting more, the attrition is high, they're expanding their operations and also rehiring also, and a heightened activity is going up. So what we can see is completely right now, in anticipation of any kind of interest rate hikes that may factored into the economy, that might completely dent the reality companies' earnings.
True.
And also high interest rate environment creates the input cost of the reality players on a higher note that will squeeze their margins. So this is the primary reason for the reality stocks to get hammered in these kind of market conditions. But if an investor have a long-term approach, Indian reality stocks, when we compare with the global reality companies, Indian reality companies are available at a much lower rates. So they can use these kind of dips and these kind of volatile movements to accumulate certain high quality reality companies in their portfolio.
Okay, understood that as well. One more news point that I wanted to discuss with you was that over the weekend we saw that LIC board has approved for a stake sale of 3.5% now instead of the earlier anticipated 5%. How are you viewing this reduced size that we may see in the upcoming LIC IPO? While this may still mean that it will remain the biggest IPO so far that India will see, but how does this really change things for potential investors who've been aspiring to invest in LIC IPO?
Sakshi, what happened is there is a change in significant risk appetite of the institutional and the market mood in past 45 days because of the unexpected change in the geopolitical environment and also the initial commentary that received from Federal Reserve. They're going to go for on a interest rate hikes. So this is the reason there is a lot of pressure on the markets. So right now, the management of LIC and Government of India, they want to launch the IPO without any delay. But the major worry for them is what is the size of the IPO during these kind of market conditions. So this is the reason they want to launch the IPO as early as possible, because we have been discussing the IPO news from past 3 months. So that's the reason LIC have brought down the issue size. But we need to see how the global investors, they are going to taking the greater pie of the available 3.5% stake. But I'm sure this is a very important IPO for Indian markets, and it's going to receive a better response, much more than anticipated.
Okay, understood that. Well, on that, thank you so much, Mr. Batini, for speaking to us and sharing the insights on the market move right now that we are seeing and the best strategies in this volatile market that investors can adopt to protect their returns. Thanks a lot for speaking to us. Always a pleasure having you with us.
Thank you, Sakshi.